Oil hit $116 a barrel on Tuesday, and it got there in 26 trading days. That is a 70% surge since the Iran conflict began, faster than 3 of the largest energy shocks in recorded history combined, according to the IEA chief. The trigger this morning was direct. U.S. forces conducted more than 50 strikes on Karg Island, Iran's main oil export hub, which alone handles 20% of global oil flows. President Trump followed with a post when the whole civilization will die tonight, just hours before his 8 p.m. ET deadline for Iran to reopen the Strait of Hormuz. Russia and China vetoed a UN resolution to reopen the waterway. The U.S. expects 9.1 million barrels per day of Middle East crude to remain offline through April. The economic chain from those strikes moves fast. National gas prices hit $4.13 per gallon on Tuesday, up 89 cents in a month. San Francisco diesel crossed $8 per gallon for the first time on record. Chicago Fed President Fasten Goolsbee put it plainly in a speech in Detroit. The stagflationary shock of oil prices is my immediate concern, before the tariff price shock has even gone away. The New York Fed's April survey showed one-year inflation expectations climbing to 3%, with gas price expectations jumping 5 points to 9%, the highest since March 2022. The Atlanta Fed's GDP Now model now puts Q1 2026 real GDP growth at 1%. 1% growth, 3% inflation, 4% unemployment. The 3 variables of stagflation are assembling at the same time. The Fed funds rate sits at 4%, unchanged for 4 months. The problem is structural. Cutting rates to support growth would pour fuel on inflation that is already running hot. Holding or raising rates to fight inflation risks cracking a labor market where ADP private payrolls came in at just 62,000 in March. Cleveland Fed President Beth Hammack said she could see a case for raising rates if inflation stays persistently above target. Goolsbee said there is no obvious cookbook for this situation. The S&P 500 trades at 20 times forward earnings, valuation that does not tolerate higher for longer rates without leap price rate. IMF Managing Director Kristalina Georgieva warned the world is ill-equipped to absorb these risks. The markets reacted immediately to Trump's morning post. WTI crude jumped another 3.2%, the VIX spiked more than 6%, and the S&P 500 opened negative. While war fears compressed broad market valuations, the AI infrastructure build-out announced a different direction on the same day. Broadcom disclosed a new 5-year agreement to develop and supply Google's tensor processing units, custom AI chips that Google and Broadcom have been co-designing since 2016. The 7th generation, called Ironwood, is now in production. Alongside that, Broadcom and Google expanded their collaboration with Anthropic, giving the AI startup access to 3.5 gigawatts of TPU-based compute capacity beginning in 2027. For scale, that is up from 1 gigawatt currently planned for 2026. Anthropic's CFO called it our most significant compute commitment to date. Broadcom shares gained 4% on the news, while Arista Networks was upgraded to buy by analysts, citing hyperscaler AI orders from the same customer base. The number that anchors the AI investment case came from Broadcom's own CEO. Hock Tan said the company has line of sight to achieve AI revenue from chips alone in excess of $100 billion in 2027. Broadcom's total revenue was less than $64 billion in fiscal 2025. That is not incremental growth. It is a structural reshaping of the company's revenue mix. Analysts at BNN Bloomberg noted Anthropic's annualized revenue run rate jumped from $9 billion at end of 2025 to $30 billion in the past 3 months. That kind of acceleration in enterprise AI spending does not pause for geopolitical deadlines. Nvidia sits at the intersection of the two stories. The stock is down 20% from its record high, pulled lower by broad market risk-off. But Nvidia now trades cheaper than the S&P 500 on a forward price-to-earnings basis, for the first time in 13 years. Its Vera Rubin platform, which promises a 90% reduction in AI inference token costs, begins mass production in the second half of this year. Wall Street expects Nvidia's fiscal 2027 revenue to reach $370 billion, up 71% year over year. The war-driven sell-off in semiconductor stocks has created a gap between Nvidia's short-term price and its medium-term demand trajectory. Apple fell nearly 5% on Tuesday on foldable iPhone delay fears, and Microsoft slipped as Iran reportedly used its infrastructure in attacks on Israel. But those moves reflect headline risk, not the structural AI spending cycle now locked in by multi-year contracts. The two stories running on Tuesday are connected by a single variable, the duration of the oil shock. If the Strait of Hormuz remains closed or contested through the second quarter, energy costs stay embedded in supply chains, inflation expectations become self-fulfilling, and the Fed's room to support growth narrows to nearly zero. In that scenario, the S&P 500's 20x forward multiple faces downward pressure, not from earnings cuts alone, but from rate repricing. Goldman Sachs had equities, but this only holds if the Hormuz disruption persists beyond Trump's Tuesday deadline. If a diplomatic channel opens, Qatar is actively mediating, and VP Vance signaled Tuesday that military objectives have been completed, oil could give back $15 to $20 rapidly, easing the stagflation calculus. In that reversal scenario, the AI build-out story would dominate market attention again, and the valuation discount in Nvidia and Broadcom would narrow fast. 2 benchmarks to watch. First, whether WTI crude holds above 110 by Wednesday's open. A break below that level would signal Iran escalation risk is being priced out. Second, the next Fed speaker after Goolsby's Detroit speech. If the language shifts from uncomfortable to data-dependent pause, that is a sign the Fed sees a path through without tightening. The final tension is this. The Broadcom, Google, Anthropic contracts are signed, and the AI infrastructure clock is running regardless of what happens in the Strait. But if inflation stays at 3% while growth stays at 1%, the multiple compression could hit even the best-positioned AI names before the revenue arrives.